The United Kingdom has fallen. I'm your host, Steve Van Metre, and thanks for joining me today. It's full damage control by the Bank of England as pension insolvencies and skyrocketing mortgage payments are causing widespread panic. Let's over to CNBC where we picked today's story up, which pension fund panic led to the Bank of England's emergency intervention. Here's what you need to know. The Bank of England launched a historic intervention to stabilize the UK economy, announcing a 2-week purchase program for long-dated bonds and delaying its planned gilt sales until the end of October. Now, this is a return to quantitative easing. Now, they're saying it's temporary, but we know it's not going to be temporary at all, as we'll make the case that this 2 weeks, and then they're going to keep going, perhaps in a bigger way. The move came after a massive sell-off in UK government bonds known as gilts, following the new government's fiscal policy announcements on Friday. The policies include large swatches of unfunded tax cuts that have drawn global criticism and also saw the pound fall to an all-time low against the dollar on Monday. And so at the same time, the reason we're seeing this panic in the bond market, particularly out of the United Kingdom, which is affecting global government debt, is because you see central banks are tightening and the new government there says, hey, we're going to give everyone a tax cut, which in turn the markets are interpreting as the central bank, the Bank of England, is going to have to raise rates even more. And that sent government bonds down in price and actually sent the currency falling as well. To prevent an unwarranted tightening of financing conditions and a reduction of the flow of credit to the real economy, they've said they'll put on whatever scale is necessary in terms of their bond purchase for a limited time. Central to the bank's extraordinary announcement was panic among pension funds, with some of the bonds held within them losing around half their value in a matter of days. And the plunge in some cases was so sharp that pension funds began receiving margin calls, a demand from brokers to increase equity in the account when its value falls below the broker's required amount. Now, it's important to understand here, when pensions buy bonds, they do not speculate on them. They're not trading them. If they're buying a 10-year bond, they're buying it to maturity. If they're buying a 30-year bond, it's to maturity. So in this case, what's happening with the pensions is they're getting margin called by their brokers, and that was going to lead to a forced sale of these bonds, something the pensions don't want to do. Now, imagine if the pension company starts taking big losses on these bonds. Well, who does that eventually going to have to get passed on to? Well, either directly to the pensioners or, in terms of the pension, going insolvent. In its emergency purchase of long-dated gilts, the Bank of England, who doesn't get it, is setting out to support gilt prices and allow LDIs to manage the sale of these assets and the repricing of gilts in a more orderly fashion so as to avoid market capitulation. And here's what the Bank of England doesn't get. These pension companies don't want to sell these bonds. They do not want to take a loss. So that's why I said earlier that they're likely going to continue this after 2 weeks when the Bank of England finds out that just because they're buying doesn't mean these pension companies are selling. We'll see what happens in 2 weeks. The bank said it would commence buying up to $5 billion of long-dated gilts, those with a maturity of more than 20 years, on the secondary market until October 14th, but we'll see just how long that lasts. Once QT restarts, these fears will resurface. It would arguably be much better if the Bank of England committed to purchasing bonds for a longer period than 2 weeks announced and to suspend QT for even longer. And that's what the market is starting to look at. That's why we're seeing a little bit of rates around the world start to come down now, because as the Bank of England capitulates, well, the market's starting to sense that, hey, wait a minute, maybe everyone else is going to follow suit, because it's all fun and games until you raise interest rates and you find out, particularly when you raise them very quickly, that just how much the modern economy and the modern financial system needs not only low rates, but perpetually falling rates. So when you drive them up real quick, you find out that certain things are going to break. The central narrative emerging from the UK's precarious economic position is the apparent tension between a government losing fiscal policy while the central bank tightens to try to contain sky-high inflation. And the other factor here that people don't get and these central bankers don't get is what's driving asset prices down. Why are stocks just falling here? Is because all this debt needs to be absorbed. So when you understand what happened during the pandemic, a lot of debt was issued. And because all these governments knew and and central bankers knew that the market couldn't absorb it, the central bankers came out and said, we'll buy it. But what they didn't know and didn't expect was all the people who received this money were going to turn around and buy stocks with it and speculate on it. Now, what they really needed was the public to buy those bonds, but the public didn't need to, because they said, why should we buy them if the central bankers are buying them? Well, now the central bankers are getting blamed for inflation, which it will say to some degree they may have some blame. But remember, QE in the past didn't lead to inflation. So notion that all the central banks work into the financial system with QE is causing all this, well, it's probably more fiscally related, but we'll allow that. So now the central bankers need to get inflation down because they're being blamed for it, and so they're doing quantitative tightening. They're unwinding their balance sheet. Now the problem, so particularly here in the US, is when there's a lot of US debt issued, who buys the most of it? Well, that's foreign investors and central banks. But during a dollar shortage, foreign central banks are net sellers. And so what's happening now is the reason you're seeing asset prices fall is because the Fed is unwinding its balance sheet, and there's one last person who has to buy all this debt, the person who doesn't want to, and that's the U.S. investor. Well, how do you get U.S. investors and investors around the world to buy government debt, which they don't want to buy to begin with? That's right, you cause asset prices to crash, because what we should be seeing right now is central bankers doing just the opposite. And we'll look at this chart here, which is the consumer price index of the U.S. We don't have the United Kingdom data here in the Fed database. And we're going to overlay the federal funds rate, because I want to show you what we should see right now historically is the Fed and other central bankers pausing to begin with, because they're not ready to offload all this debt on the economy. We need to see the global economy much stronger to handle all this debt, and we need to see governments issuing less debt. But here you can see back in the early 90s, we note that the federal funds rate in red drove up. You see the CPI flattened out and the Fed kind of backed off. You see it here around 94, 95. We saw it again in around 2000. Here around 2007, they did it again, 2006. And so we know that what we should be seeing here in the near future is the Fed back off, and what we're not hearing about is how they're ready to do that yet. Now, we might see something by November. Maybe the data will come down, but that's the problem right now, is the reason markets are falling is because U.S. investors need to buy our government debt, and around the world, domestic investors need to buy their government debt, and if they don't, well, asset prices will continue to fall under QT until it does. But things in the United Kingdom aren't getting any better, because that's only part of the story of what's driving the BOE's intervention. The other reason is the panicking is 26% of all UK mortgages are variable rate and set for immediate repricing. And of course, not every mortgage needs to be refinanced today, so these rates have some time to change before most refinance. However, unlike the U.S., where a 30-year fixed market dominates, the FCA suggested in August that 26% of the total outstanding UK mortgages are variable rate and thus dependent on where the Bank of England's bank rate is. So 26% of mortgage payments are at risk of imminent increases, 30% at risk over the next 2 years if rates don't rapidly fall, and 30% they estimate can ride the storm out for a few more years. And what we can tell then is that means mortgage payments are going to absolutely skyrocket, and again put central bankers in a precarious situation where they're going to get rid of inflation by causing a massive global recession, if they're lucky, perhaps even a depression. As Reid concludes, while much can change very quickly in politics and markets, if markets are correct, the UK housing market is in for a huge amount of pain ahead unless the Bank of England were to somehow monetize all the upcoming debt issuance and send rates back to zero, the case I've been making for a long time. But one thing that shouldn't experience maximum pain when things blow up is your portfolio. I'll put a link up here to Portfolio Shield and the description below. Let's continue on, because the story of what's going on in the United Kingdom and their bond market gets even deeper. The UK long bonds post record rally as the Bank of England moves to stem crash, and what we saw is they had their biggest ever one-day rally after the Bank of England stepped in to halt the market crash fueled by forced selling, which I don't think they did, but we'll see, from pension funds. The yield on securities plummeted a whopping 106 basis points to 3.93% after the Bank of England said to buy an unlimited amount of bonds until October 14th. But we'll see just how long that lasts, because I think it goes a lot further. Today's announcement will stem some of the tide of selling flows we were expecting this week, but the announcement is only sticking plaster to a much wider problem. Certainly a market would have benefited more from the government blinking first, not the other way around. And the moment the markets start to sniff out that, of course, the central bankers are going to come back to do QE, you're going to watch money plow into bonds and drive rates down ahead of that. But the real issue here of what we're seeing, and not just in England, but we're going to see around the world in global economies, is just the rate of increase in tightening. And we've never seen this before. And this is a big problem. I want to take you back to the chart we just looked at, but I'm going to change the federal funds rate to a year-over-year basis. Because in the past, you may remember when the Fed increased, they do like 0.25%, and then they wait a little bit, and then another 0.25%, and then they wait a little bit. And the reason central bankers did that is to give the markets and the economy time to absorb higher interest rates. Well, this time, they didn't give anybody any time. They just ratcheted them up and appear to not be on a trajectory to stop. So here you can see the federal funds rate in red, and note, look how fast, in the past, we see on a year-over-year rate, it went tighter, and then inflation came down. But it didn't go a really big spikes. Look at today. This is right now the biggest spike on a year-over-year rate of change in the federal funds rate in history, and this hasn't hit the U.S. economy yet. It's impacting the stock market along with quantitative tightening, but we haven't seen the full brunt of this. And not only has the U.S. not seen it, perhaps the U.K., China, and other countries that are tightening around Europe and all around the world, they're going to see just how bad things are going to be when central bankers have gone too far. The UK's crisis of confidence was years in the making, suggesting that this wasn't just the beginning of the problem, that the problem's been going on for a while. As Friday's mini budget has become a flashpoint not only for investors' short-term concerns about unfunded tax cuts at a time when inflation is running close to a 4-decade high. It has given sharp focus to their long-held fears about Britain, its current account deficit, its fractious relationship with its closest trading partner, and above all, mistrust of what successive politicians promise. Now, what you could do is you can take all that language and you could apply that to almost any other country, and it would start to make a lot of sense of what we're going to see here in the future. It's the latest in a long line of self-imposed, economically illiterate decisions. It started with Brexit, and now we're seeing the latest iteration. Between Brexit, how far the Bank of England got behind the curve, and now these fiscal policies, I think Britain will be remembered for having pursued the worst macroeconomic policies of any major country in a long time. Of course, we could actually say that again about any of these other countries around here when all of this tightening comes to roost, and soon we'll see it. But there is a little bit of good news. Well, at least here in the U.S., unemployment claims continue to fall. Here we can note for the week, last week, we see unemployment claims back under that 200,000 number, defying the fact that the economy is slowing down. We see a 16,000 drop to 193,000. Even state claims drop a whopping 29,000. But will that hold? Well, let's turn to our chief strategist, Jeff Snyder, who perhaps suggests that there's not a chance that those claims are going to stay low and only going to head higher. When we look at wholesaler retailer inventories, the advanced estimates for wholesale inventories rose 1.3% in August 2022 compared to July. Accounting for prices, CPI in inventories gained 1.4% month over month. His key takeaway from this is a preliminary inventory data for August is that both retailers and wholesalers to this point have only recently begun to take modest stops to gain control of their stockpiles. Addition to wholesale inventories, even when accounting for inflation, having the most moderated from the historic rates early this year. A sample from Urban Outfitter CEO Richard Hain, he said, "I hesitate to call it a bloodbath, but it's going to be ugly in terms of the amount of discounting and markdowns." In other words, the real downswing to the manufacturing inventory cycle hasn't even started yet to prices and the economy, suggesting that what we're just seeing here in the United Kingdom is going to filter all the way around the world. You're going to see central bankers realizing they went too tight. You cannot raise rates this quick. The financial system can't react to it quick enough, and whatever pain is coming, you're going to see a massive pivot. Of course, we know Jeff has been predicting that for a long time. One day left on Markets Insider Pro for free. Check out the link in the description below, marketsinsiderpro.com. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.